Hey everyone, and welcome to this Angeles Foundation webinar. Angeles Foundation is the philanthropic arm of Angeles Investors. The foundation is based out of Chicago, and it's a nonprofit organization that provides socioeconomic empowerment and programming. The foundation is dedicated to providing resources to three types of people. First, prospective investors, and they get webinars and investment fundamentals like this one. Community members, and third, startup founders. With that, today we'll have an amazing topic and an amazing speakers. We'll be talking about one asset class that is very common for investors and is real estate. I will introduce our amazing speakers. I'll start with Jairo, our first speaker. He's a capital strategy advisor, investor, a multifamily real estate operator, and he brings a practical perspective into how investors and also operators evaluate multifamily opportunities. Welcome, Jairo.
Thank you for having me.
Second, we have Brian Burciaga. We're also pleased to have you. And Brian is an investment professional with experience across public and private markets, including real estate. So Brian brings like the research-driven lens for the conversation, and with his expertise in fundamental analysis, due diligence, and how to evaluate real estate so that it gets into the broader investment landscape. And finally, we have Jason. He's the founder of Terra Bridge Advisory and is a seasoned executive across real estate, mortgage finance, prop tech, across border strategy. Jason brings a unique perspective on how demographic shifts, multicultural markets, and international dynamics are shaping the future of real estate. So with that, I welcome all of our speakers. Thank you.
Hello.
Perfect. So to start, I wanna start with the asset class from the operator's perspective. So Jairo, your perspective in multifamily investing gives you a very practical lens into what is happening on the ground. Specifically in terms of execution, repositioning, how investors are evaluating opportunities in today's market. So Jairo, when you look at the multifamily market today, what are the most important trends you're paying attention to, and how are those trends shaping the way you evaluate opportunities?
Great question, Joshua. Thank you so much. It's an honor to be part of Angelus, the investors, and thank you to the foundation for this webinar. So I focus on a couple of areas when evaluating multi. Piece is the interest rate and the cost of capital, right? So especially with higher rates now, it directly impacts both bridge loans and traditional financing. So what that means is what may have worked 12, 18 months ago on paper may not work today, right? So you have to pay close attention to how sponsors and individuals are structuring specific deals, right? Also managing those cap rates or rate caps and planning for refinancing also. The second piece is also cap rates and price adjustments, right? So we're seeing cap rates expand into various markets. So it's also creating buying opportunities, but only if you're disciplined, right? You can't be reckless. So you have to look where deals are realistic spread between the cap rates and also borrowing cost, when it makes sense, right? And you can't just go across projections, let's say, or just a pitch deck. You have to do your research, right? And that leads to my last point, which is the fundamentals at a marketing level, right? So understanding the population growth, understanding job migration, understanding rent trends, understanding overall demand for housing, right? So you have to dig into local components as operators, such as like the crime rate, quality of life, right? Things of that nature, because at the end of the day, you have to be, it's also the safety of the tenant as well, right? So that's how they folks choose their communities, right? So for me, it's all about aligning numbers, interest rate, cap rates, and then with strong, durable market fundamentals. So there you go.
That's very interesting because you're grounding us into what's happening at the property and market level,
Yeah.
which is a great starting point for this conversation. And I wanna hear Jason's perspective next, and is I want to expand that lens into the broader real estate ecosystem. So particularly, I want to touch base into markets, how markets become more connected across geographies, buyer segments, and international capital flows. So, Jason, from your cross-border and industry perspective, what major trends do you believe are reshaping real estate today, specifically across multicultural and international markets?
Yeah, certainly. So thank you. Thanks for this opportunity. It's exciting to talk about this. Certainly, as you mentioned, real estate being such an important asset class. I think for many, it's also, I think, the first pathway, the foundation to wealth building, right? And so individuals, and as they progress. So I think that the sophistication that's involved in this can go in many different ways as people explore it, even for themselves. I had the privilege of being involved with NAREP, the National Association of Hispanic Real Estate Professionals, and I can tell you that even though people that are involved in the real estate space that are selling and transacting, oftentimes we're not familiar with the more sophisticated ways to invest and also to grow their own wealth via real estate. And I think, through concerted efforts like this and the conversations that we're having are very crucial because, as you know, our Latino community hasn't always had the access to these types of conversations. And so I'm a big fan of what Angeles is doing. It's really transforming, I think, our communities, every year by everyone that joins and its membership. So I'll take your question here and I'll divide it into two. I think when you talk about the multicultural and then, of course, the more global and international flows that are happening. Multiculturally, I just want to point out that Latinos are not just a niche when it comes to home ownership and what's happening in this country. As a matter of fact, in 2025, Latinos had a record-breaking growth year. So Latinos added an overall 441,000 new homeowners to reach a historic 10.2 million overall. So that's the largest gain ever recorded for our community. And we drove as a community 92% of new household formations in this country. So let that sink in. A population that is considered 20 something percent, of the country is driving 92% of new household formations. So this whole country is really being transformed by our Latino community in terms of the demand. And why is that? Because we are really in those prime real estate buying years, home buying years. And so if you're not involved in this community, and we tell this a lot, and when you're involved in the sector, if you're not working with the Latino home buyer, you're not going to be in this market in the next 10 years. That's just the reality of it. Right now, 90% of sellers are white, but 90% of buyers are Latino. Imagine that juxtaposition there. Very interesting thing that's happening. So that's, I think, the dynamic in our country from Latinos, and so that's tremendous. And I said all that, and if you know what 2025 happened, of course we know what's happening this year. There's a lot of headwinds against our community, not just the overall market, but we know that rates, inventory, just even the targeting of our community itself has been very significant. And so that's one side of that. On the international side, I am very excited about this because we are also seeing a different shift that's happening. The traditional markets in terms of international buyers coming into the U.S. have always been there. But now I'm thinking we're really starting to see critical mass outside of the U.S. For Americans looking abroad, right? So last year, we know that we actually saw the largest exodus out of our country, net migration. So this is the first time since it's been recorded for a while, migration to our country with an estimated 150,000 more people leaving than entering the country. So that's a big opportunity there that we're seeing happen, and you can all take advantage of those things that are happening within this to capture that interest that's happening. And there's several reasons behind that. I could go into it deeper, but I think people are certainly seeing one, the opportunity that they have to live perhaps a better quality of life somewhere else. They're also maybe looking at retirement, the ability to remote work. What we saw COVID, I think, really further accentuated and pushed it forward. And then we're also seeing a drawback to your heritage, right? There's a company that I work with. They started here 2 years ago, have now over 800 agents solely in the United States, and they're a Mexican developer. And what they do is they sell directly to Mexican are looking to buy into Mexico. And so that is the demand. They're seeing just serving the Latinos in this market that are interested in buying in Mexico is a huge market for them.
Thank you, Jason. And you're highlighting, how real estate is evolving not only locally, but through a broader demographic, right, and market shifts. I like what you mentioned, and it's like Hispanics are right now, which is a little bit of a focus on analyst investors. Is Hispanics are right now, but are the ones that are buying more real estate than any other in this city, right? And I like to point as well that Latinos are the ones and Hispanics are the ones that are doing 10 times more business every day in the startups than any other ethnicity in the US, which is a very powerful point, right? And of course, they increase their amount of wealth 10 times more because they come from literally nothing to a lot of things in the US. And that's part of a consideration into how the demographics are working throughout, not only locally, but and in a way of internationally as well. So, Brand, to this point, I would love to bring I would like to bring you into the conversation and the research and investment perspective that you have, because understanding trends is one thing, but knowing how to evaluate them, you know, with due diligence and this asset class is very specific. So, Brian, when you assess real estate from an investment research standpoint, what indicators or signals do you look at first? And what makes you understand whether the asset class is becoming more or less attractive?
Yeah, yeah, no, definitely. Thank you for that, Yeshua, and thank you to Angeles for hosting this and having me. And great responses from Dr. Jairo Borja and Jason as well. Love where this conversation is headed. So I guess just a high level overview, like you said, I evaluate things usually mainly through the public equity lens, and I'll delve deeper into what that means. But uh, from my perspective, when I guess to break it down, to even just give context here, from the public equity standpoint, you have to remember that to go into what Jason was saying here, right? Like, um, one of the biggest ways that you've historically been able to gain wealth in this country has been through real estate, right? But there's oftentimes some barriers to that, and we can go into that if needed. But to talk a little bit from the public equities perspective, the two key things that you have to remember is you're looking at two things. You're looking at REITs and you're looking at real estate ETFs. So just what are REITs? What are ETFs? What's the difference between that and physical kind of traditional real estate here? So at a high level, REITs are publicly traded companies that own and operate income producing real estate. What's unique about them is that they're required to redistribute 90% of the taxable income that they had that year as dividends, right? So if that particular year one company went from here and it grew X percent, 90% of that taxable income has to be distributed as a dividend. And so that's an interesting thing because, as I'll go into in a second here, you get to have access to these different real estate markets through a way that doesn't necessarily always require the same level of capital, right? So that's a REIT. What's a real estate ETF? Looking at a bundle of multiple REITs into a single tradable security. One example is the XLRE. It holds 31 companies from the S&P 500 across 12 different subsectors. So if you want access to healthcare real estate, if you want access to data centers, retail, right, the list goes on and on, you can do that through one security, and that's a REIT. So there's pros and cons here that I'm sure we'll talk about, taxes, all these sort of things. But just wanted to give that context from when I'm evaluating, I'm looking at it from that standpoint. But to answer your question about like, how do I actually look at this framework, right? One disclaimer, this is not investment advice. This is general how I think and some general frameworks of how people think. But the question of like, how do I assess real estate and look at it from that standpoint? Three things. One, I look at the 10-year treasury rate, right? You look at what that's trading at. So today, that's like around 4.42%. And you compare that to a cap rate that you find, right? Typical cap rate for like a multifamily that you might see might be like 5.5 to 6%, right? And you look at that difference, that spread. And so what's interesting about that is today that 10-year yield, treasury yield, 4.42, and that typical kind of cap rate, you look at that spread and it's like between 100 to 160 basis points. Historically, over the last 25 years, that spread has been an average of around 250 basis points. So what does that mean? Used to be 250, we're at 100 or 160. That means that extra spread where you could have made extra gains is actually a little bit compressed. Things are tighter, right? So I look at that. I also look at the difference between the public and the private valuation, right? So one of the key things that we have to remember is on the public side, that often leads the private side. What happens in the public markets, you oftentimes see kind of lag maybe 6 to 18 months later on the private markets, right? And so I'll give you an interesting example here. So let's say that you find yourself with an interesting investment opportunity in a multifamily and it returns 5.5% cap rate, right? That's what you're looking at. You look at the public side, a multifamily apartment kind of ETF or REIT, that implied cap rate today in March 2026 is closer to 4.8 to 5.2. So that means one of two things. Either you found yourself a really great deal at 5.5 or whatever it is, but everything else is kind of at 4.8 to 5.2, and you found yourself a great deal, or historically, what that happens is you have this public leading and the private lagging. So I look at those things, and then the final thing I'll say here is just the overall supply demand pipeline. What is overall consumer sentiment? What are constructions? What are new builds? I look at all these things similar to what Heido was saying earlier, just to kind of gauge and say, what is everything kind of trading at a macro level, and what does that mean in terms of the risk that I have to take? So I'll pause there and happy to go further.
Thank you, Brian. No, and that's very interesting because now we've touched two topics. One is the market and the trends, right? And now we've touched, how the investment behind the scenes, kind of the due diligence, what things you gotta take a look at, right? And now I want to get a little bit more into the execution side, because even when people like the asset class and they see it as, the first asset class you usually invest in to generate wealth, it's often known is often a challenge knowing what best practices matter the most when you're actually going to enter and operate in it. So my next question is to Jairo, and for someone looking at multifamily and income producing real estate today, what best practices do you think matter the most in terms of underwriting, operations, and risk management?
Great question, Brian. Great point so far, Jason and Brian. I think everything ties together. Shout out to the moderator, Joshua, for that. But yeah, when it comes to underwriting, like shout out to Mike Ely, which Jason knows very well as well. He knows very well. So at the end of the day, when it comes to the underwriting component, especially when it comes to multifamily, you have to look at the T12 and the rent roll and trailing performance. Right. So what does that mean? So basically, like what is the expenses? What is the net operating income? What is the rent in regards to the actual multifamily or deal? And on top of that, using like tools such as Rent-A-Meter or CoStar or even Morningstar or Bigger Pockets to an extent, to understand the true market rents, right? Not just what the seller's telling you, right? I always stress conservative underwriting when it comes to realistic rent growth, higher expenses, assumptions, and everything that I mentioned in the first question. Understanding like the area, any companies coming in, the demographics, and all that stuff, right? And then of course tying it to what Brian was talking about in regards to interest rates and cap rates, right? On the operation side, if you don't have it in house, is basically having a strong property management team, right, with a proven track record that it's able to help you when it comes to leasing, tenant screening, when it comes to turning the units over, and then collections, right? Because that's the difference between a good deal and a great deal. It comes down to how well the property's managed day to day, right? And on the risk management side, it's about being proactive and not reactive, understanding your financing structure, especially in today's environment. As I alluded to earlier, understanding the debt terms, understanding the cap rates, and refinancing risks associated with the deal, knowing your local market, right? That's why, I lean on Mike, my mentor Mike, with his markets in the Midwest and also in the Carolinas. Also, as an operator, understanding the eviction laws and tenant protections and economic trends, that's also very important, right? Because let's say if someone's not paying you rent 2 months, 3 months, 4 months, or a year, that's money that's hurting your pocket, right? So you have to understand the laws in and out as an owner, right? And at the end of the day, when it comes to like getting deals, especially in the world of multifamily, it's all about building relationships with different brokers, attending different industry events, and staying informed with like newsletters and podcasts. So you're not making a decision, impulsive decision. You're making an educated decision based off what you learned, in the market. So strong underwriting, strong operations, and being able to stay informed helps you make better decisions.
Perfect. Thank you, Jairo. And you're getting us into the practical side of execution, and that connects very well to what Jason was mentioning earlier. And it's because the best practices also change depending on the market. You were just talking about the Carolinas, how it could do in the West, how it could go in the East. So it depends a lot, right? So it depends on the market and the consumer and how different segments are involved, right? Ethnicity, whatever. So, Jason, my question to you is, as you look across residential real estate, mortgage, and prop tech, what are the best practices do you think leaders need to adopt? And in order to stay relevant and as the market becomes more digital, diverse, and globally connected, what are those things that you look at?
Yeah, so I spend a lot of time just kind of thinking about this from a standpoint, right? With AI and now the world that we're living in, what's that going to do? I think that there used to be a time, and going back to even the trends about international buyers, is that um, I I think that those days where regulation was certainly the big driver for business ideas and being able to maneuver, those are probably going to kind of fade away over time. And so in the US, I think those anyone that's really looking from, if you're looking at it from a business standpoint, so if you're a prop tech company or someone entering into this market or trying to launch something that works in that residential space, you certainly have to be you have to understand very well the go-to-market strategy and also the legal environment for every state that's out there. And so I'll give you an example. I used to work for a company called Notarize. It's called Proof now, and they're basically the company that really pushed for remote online notarization in the title process. Now, mind you, this adoption was really driven by COVID, but still had to be implemented and fought in every state across the country, right? So this is a legislative type of issue that has to happen. And so, regardless of how great the technology is, if it doesn't work within the confines of the bureaucratic system, it's not going to work, right? Because even if you have the great technology, once it goes, let's say, down to the public auditor or someone that's got a file at a local county, they're already backed up. I mean, you think that they're going to be able to use your technology when they're operating on DOS? So that's kind of the reality that we're living in. However, on the flip side is that outside of the US, there is this void. There's a lot of I think, unknowns outside of the US, a lot of fear. There's a lot of people that can get taken advantage of. But technology, I think, is going to kind of leapfrog a lot of these residential markets outside of the US because of the access to information, the transparency. And so where maybe, real estate agents or other brokers were really the ones kind of driving these kind of properties and listings, you're going to start seeing them become much more open and accessible, right? So outside of the US, if you're interested in buying something, typically you might go and find, you have to go to each brand or someone that you know, and you might see the same listing in multiple sites and it could be expired. There's no real clear regulation, and also licensing, you name it. And we can talk about that, how that is. But for me, I see that technology is going to really leapfrog a lot of what's happening in real estate outside of the U.S. We're going to get there, but I think there's going to also come a harsh reality for those that are kind of in this Web 2 kind of environment. It's going to change, right? And so your value proposition is going to come certainly going to be there. You need to be an expert in what you're doing, and AI is going to help facilitate that. But I think a lot of what you see from a portal perspective, the way that people are searching and finding properties, that's going to change tremendously. And now the world is our oyster, really tremendously from that standpoint, as you're buying and looking for homes. I think that's what I'm really excited about and kind of seeing. And the legal sophistication, I do see as an opportunity. So if you are interested from an investment standpoint to look abroad, you might not have everything that you have available here from insurance or the requirements that are there, but you can find those products to really protect your purchase. And so whether it's from the title side or the insurance side of things, they might not be required in the country, but you can find those in the private market, being able to do that. The legal process has become better in some countries where you're seeing, the process itself, or whether it's through a trust or some sort of entity, those are there, and I think that that ability is going to become much easier for people.
Perfect. You're pointing to how operating practices and market expectations are evolving together, right? We have disruption happening in all the industries that will include real estate as well. And for example, you just now market expectations, as I was saying, the buyers now just need to go into on a specific platform and they show the listing, right? The the operating practices, it's now easier for someone because you don't have to do all these tours, right? You can record the tour and everything. So everything is changing, right? And I want to stay on that theme, like how everything is evolving together, because investors are also constantly reassessing what they need to believe about the market before committing capital, basically. So, Brian, what are some of the biggest mistakes investors make when evaluating how real estate opportunity works, and what do more disciplined investors do, and what are the difference between?
Yeah, absolutely. Great question. No, I loved what Jason just said. I think a lot of that really resonates, especially now, right, where we are, late March of 2026. Things change on a week-to-week basis these days with AI and everything that's occurring in the market. Tools that professionals have been using for years, suddenly they're at risk, right? Of, is this really truly the best tool out there to help me evaluate and make decisions? So yeah, totally plus one what Jason just said of um, utilizing the tools of the day to the best of your abilities, not just to gain access to information, but really to like teach yourself things too, right? Like you might play around with tools like Claude for finance, or whatever the tool is, but like to teach yourself things and skills that used to take way longer to evaluate and do processes. And so now you're suddenly kind of being able to really compete with professional investors in a way that you couldn't really before, right? Like you're if you know just a little bit, you could be dangerous, right? And so I think that's a great point. And then other mistakes that I think investors make when they're evaluating real estate deals historically, I would say is ignoring the opportunity cost. You got to look at not just like the cap rate and the NOI growth that you expect, but oftentimes I think, especially again from my public view, evaluating it from the total macro perspective, looking at the treasury yield. Okay, so if you have this difference in extra return, and that's now compressed to be less, is that worth, and does that justify illiquidity if you invest into a physical property, concentration into one property, the operational burden that it takes to manage these things, right? And so you have to keep into account those those points. The other thing that I think investors need to kind of remember, like I just mentioned in the earlier point, is comparing to the public markets. Um, Again, check the implied cap rate of whatever corresponding public REIT you're comparing against. If you're looking to do an investment in multifamily or retail, or if you're doing an office, whatever, compare that to the public REITs and see what their implied cap rate is, and see what that difference is. Again, if there's a huge divergence, you have to kind of interpret that. So all that to say is, I think, use the tools of the day, which today that's a lot of these LLMs, to teach yourself new skills and learn all these different things, and use it to its maximum ability. And also use as much data, not just from your specific niche, your specific sector, your specific region, but also look at the broader market, because oftentimes that might tell you a story that you might be missing. And I think that's ultimately what very savvy, successful investors do. So I think that's kind of how it wraps up there.
Perfect. And I think you're highlighting, the discipline required to evaluate real estate well, right? And that links directly to the decision making process for families and entrepreneurs that are and want to allocate capital over time, right? But in order to allocate capital, you now need to think on the market itself, right? Because one of the biggest questions today is not just where the opportunities are, but how the asset class is changing, and from what investors may have expected a few years ago, right? And that gets us again to the trend, how everything is changing, AI, right? So my next question is to Jairo. And Jairo, how do you see the multifamily and broader real estate market evolving over the next few years? And what do you think investors need to adjust in their expectations or approach?
Yeah, great. Thank you, Joshua. Great question, and Brian and Jason, great points when it comes to AI and using data, to make educated decisions, which I'll get to that in a minute, right? So, where I see it is, I still see growth in the Carolinas where I invest in now, Georgia, of course, parts of the Midwest, Indiana, Ohio, Kentucky, and what I've seen pockets of Texas, and then there's other, but those are the ones that I know are still pretty good to invest in, right? So, one thing I wanted to point out is, you know, although yes, there's a rise in ownership, right, but it's still a little challenging, right? So for now, what I'm noticing as well is, which with those challenges makes it more people are renting longer, right, for whatever reason. So it keeps pressure on occupancy and keeps pressure on rents. On top of that, you're starting to see a big gap in affordable housing. So one of the deals or some of the deals that we do in the Carolinas is a LIHTC, low income housing tax credit. So they're in high demand, but supply is still short. So being able to work with your municipalities, work with your elected officials, and to help close that gap, right? So even with challenges such as like higher interest rates or operating costs or occupancy rates, those are all strong, which tells you there's demand and real persistence. So it's all about collaboration and partnerships locally, right? So what investors need to adjust is expectations and strategy, right? So deals is not just about aggressive projections or fancy pitch decks. So about disciplined underwriting, patience, and at the end of the day, strong operations, right? So you got to plan for a higher cost of capital or raising that capital and focus on the long term game, long term fundamentals, not necessarily the short term wins. On top of that, at the end of the day, it's about what separates the great from the good, right? To say it's about collaboration and technology, right? So real estate at the end of the day is a team sport, right? I can't do it by myself. I need Jason, I need Brian, I need Joshua, right? And you have to work closely with the brokers, lenders, and partners is key, right? And of course, other stakeholders, especially if you want to get into affordable housing, right? And the best operators leverage technology and AI, as Jason and Brian alluded to, right? So having whether it's like leveraging technology such as a AI agent to remind the tenant that rent's coming, or leveraging tools when it comes to, hey, your lease is coming up, and how to automate that process as opposed to making it less manual, right? So being able to leverage technology and AI to improve communication and efficiency is going to be key, and is going to be what makes the good operators great, right? So at the end of the day, it's about three things: discipline, adaptability, and at the end of the day, execution. And that's how the strong will survive.
Thank you, Jairo.
Thank
My
you.
my next question, and maybe switching a little bit gears to Jason is, Jason, looking ahead, how do you see the real estate evolving as an asset class? I want to get your insights, particularly from multicultural demand, international
Yeah.
movement, which is a couple of topics you've said in the past, and new technologies, because you also bring into the conversation the prop tech, uh, uh, perspective and how it is influencing the market. So, how do you see real estate evolving as an asset class?
I think that the ability, I think Brian hit on this a few minutes ago as well, which is, I think if all of us, if we were to break it down in terms of real estate, which is you can invest in it in a lot of different ways, right? And that's the beauty of it. So um, whether you're looking at it to live in it as an owner occupant, right? Or to rent it out, or you want to have multiple units, you want to be an operator, that's great. Or you don't want to mess with any of that. But maybe you don't have the money to invest in a REIT, or or in one property. You can now, fractionally go about doing this. And so the accessibility, you have the EFTs that were talked about. And so there's so many ways to do that now. And so I think that the way we're going, and we tested this a little bit, it didn't go very well because a lot of people, I think, kind of messed up. Early adopters kind of can get burned in this. But when you're looking at tokenization and what's happening in real estate, I don't think that's going to go away, that conversation. But going back to everything that we're talking about previously, which is the process by which one can buy and secure real estate, I think blockchain is going to continue to be a part of this conversation. Tokenization, all these things, as they become much more prevalent and are adopted, are this, it's the way that it's going to go, in my opinion, because that is going to certainly going to improve a lot of the things that in terms of security or title, whatever that might be, and in securing your investment. I do see it going in that route. um, but yeah, so real estate, I'm very optimistic on it. Continue to be, despite everything that we know. So I hate to just kind of beat a dead horse, which we know that here in the U.S., just the costs to build, it's excessive. We have a lot of constraint now with, of course, labor. I don't need to say that at all. I mean, everyone's kind of trying to do this, but in the long run, it's still, it's I'm still very bullish on it.
Thank you. The other day, I was having a conversation with our CEO, David, and we were mentioning, okay, after AI takes over the world in robotics, let's say we go into the Star Trek mode, what is going to be left? And we were talking, okay, social interaction between humans, and amusement parks and all different stuff of experiences, right? And for that, you will still need real estate, a lot of real estate, right? Because productiveness will increase a lot because robots, everything AI. But in order for it to happen, you will need to build a lot of real estate to manage that, right? So I definitely agree with that. I want to
Yeah, the physical world's
ask
not going anyway.
that's correct. And I want to ask Brian next, bringing back a little bit on the investor lens, and then I'll ask all of you one last question. And it's, what parts of the real estate market do you think deserve more investor attention? And to all of you guys, where do you believe caution is most warranted right now?
Yeah, yeah,
And we
no,
need to
absolutely
be,
great.
because we've talked about how we can invest, how you take how you execute, how you produce, what are the trends, what are the markets, but I think we're missing a little bit on the risks. So that's the next question to all of you.
Yeah, no, absolutely. Yeah, I guess first, real quick, a great reminder and point by Haido. I've been talking a lot about ways to evaluate these things, very kind of technical, but I guess you really brought up a great point there, Haido, of relationships. I think, to answer your question, Yeshua, what parts of real estate market deserve more investor attention? I'll get to kind of more specifics in a second, but I think one key thing that you can't underestimate is relationships, right? Like Haido just mentioned, we can't just do it all by ourselves. Whether you're actually physically trying to buy a property, or even if you're interested in like an ETF, or investing in like a REIT or something, right? It does require a level of like collaboration with somebody else, so that you're making the right decision. So I think that's one that, especially with AI and all these tools and level setting of everyone is getting, there's more democratization happening. Relationships is going to be very key. Now, in terms of like areas to pay attention to and areas to be cautious, um, I would say if you're looking at like specific subsectors within real estate, um, looking at like the top REITs that were performing in last year in 2025, uh, one of the top ones, if not the top one, was senior housing, right? There's an interesting stat like the percentage of the population that is 80 years old or older is growing at a rate of like 4.6%, and construction for that is not there's not enough supply to meet that demand, right? And so even if you look at like an ETF, one of the largest for XLRE, one of those ETFs is well, so it's around 10% of that ETF. So it shows you like a big chunk of this growth is going to come from this demographic play of people are getting older. You also have to look at healthcare REITs, right? That's also continuing to grow and change. I'm here in my building in South Florida looking at a facility that they're building for healthcare. So, that tells you something else there. I think it's crazy too that we haven't really touched too much on data centers. I think you have to not ignore that, right? There's a ton of growth there. In AI infrastructure demand is probably the most powerful kind of secular tailwind of anything in real estate for this year and probably for the foreseeable future. So I think you have to consider that at some standpoint, and then maybe to a lesser degree, some industrial or logistics, right? Humanoid robotics and all these different things are coming. I'm sure. I know Angeles talks about that in other aspects as well. So I think you have to consider that. In terms of risks, I think you have to always remember and look at, again, similar to how I talked about high performance in healthcare and data centers, what also didn't perform that well in previous years. And recently that's been like office, right? And so, we can go further into that, but high level, that's an area that I would caution. The other thing too that is super interesting and super important is there's a lot of debt that's maturing in 2026. It's something like $875 billion or something like that, and that's part of like a $4 trillion tranche of debt that's going through this refinancing cycle from now until 2029. So there's a ton of debt that's maturing. We keep getting this refinancing and back and forth, so that's always kind of a risk. And Yeah, I think those are the key components there. Obviously, you have to look at mortgage rates and where that's going, interest rates, FOMC. So a lot of stuff happening, a lot of stuff in the macro. Who knows what's going to happen with Iran war and so forth? But interesting things to watch and look at the data, and that's going to tell you on the public side what potentially is the story for the private side. So I'll pause there.
Thank you. Uh, let's go with Heido. What about risks? What's your opinion on the risk, related to real estate?
Yeah, no, Brian brought up some great points when he was chatting, talking before in regards to, yeah, there's a lot of opportunities when it comes to data centers, right, and when it comes to senior housing, senior housing, right, as you know, 10,000 baby boomers retire every day, so there's a lot of opportunities there. When it comes to the risk, though, whether it's those two asset classes I just mentioned, the data centers or the senior assisted living, or even just multifamily, the risk involved in that is as he exactly just mentioned, right? A lot of debts expiring now this year. All right, so people are going to scramble and refi, right? Goes back to my point earlier, right? When you evaluate a deal, you have to make sure you look at it, in and out, right? The T12 rent roll, everything, right? Be as conservative as possible, because what happens is, what if you purchase an opportunity, right? What if you get that bridge loan, but maybe what if what you underwrote, it's not there, right? Whether it's like the appreciation of the apartments, or appreciation of the I'm sorry, whether it's the stabilization of rent, appreciation of the property itself. Like, what if you do that correctly or incorrectly? That's a big risk, because then now what? It's an interest only bridge loan, and then you have to pay that back, right? With principal in 18 months to 18 to 24 months. So that's why it's important when it comes to evaluating a deal, evaluating it from a holistic standpoint, so that, as Brian mentioned, you don't have to pay that bill in 24 months, incorrectly. So that's the risk there. The risk involved is um, being able to underwrite it incorrectly, or coming way short. So that's why, and if you don't know how to underwrite, just always seek for help, right? Seek for help when it comes to that, because God forbid, right? You underwrite that, or you underwrite that incorrectly, it's gonna cost you a lot of money. You and your investors a lot of money. So
Thank you, Jairo.
no.
Jason, what about you? What do you think on risks about this industry and this asset class?
Well, I think, if just what you were talking about, your conversations with David, in terms of like, if we hit the ultimate AI reality, right? Then at that point, certainly there is going to be a very difficult transition, right? In terms of when people maybe don't have the income needed. Industries are certain, we're seeing a lot of that. The economy currently right now is certainly wobbling. And so, will real estate be impacted? Absolutely. And you talked about the debt that's out there on the commercial side. I don't, the strain is not there as much on the residential side of things. People really, in terms of default rates, are still pretty good. But I do feel that if things get worse, yeah, the next thing that comes off, people start paying their credit cards. Then the next thing comes, things like their mortgage and other things. But I think that is part of just any big economic cycle that hopefully we can get out of it, get out of here over the next year or two. Um, and so we do have a lot of headwinds. That's what I'm saying. I was very optimistic in the long run, but we know that we have some difficulty ahead. I would say, if I'm being pragmatic.
Perfect. Uh, I want to open it up for two or three questions that I see on the chat. So some Q&A. If you have a question, put it in the chat. I have uh, I have one for each of you. I'll start with Hairo. Audra in chat is asking, I would love to get your thoughts on how to transform large abandoned commercial real estate locations into community housing.
That towards me.
That's it.
Yeah, no. Yeah, I would just double check with your town, make sure that it's not zoned for anything, or right. But once that's all clear, it could be a UEZ or economic. But once that's all clear, if you think if it's worth it at that point, then yeah, because the town may have it designated for something different, right? So, but I would say I think it's a great idea, right? Because there's a affordability crisis, so why not? Why not? So just once you get that clear, work with an architect, work with a developer, and if environmentally, if you could do it, why not? I love it. I love the idea for sure.
Perfect.
Yeah.
Next one is for Brian. How should, and this is for Martha, how should investors think about the trade-off between patience and timing when deploying capital in this market? Because if you're seen as an investment, usually it will take some years for you to see, some return back.
Yeah, no, that's a great question. So I guess one, it brings me to the classic. You can't necessarily time the market on the public side, right? When you're trying to invest into public equities, it's better to have time in the market than to time the market. That's what they always say, right? But I guess when it comes to like real estate and really a lot of different sectors, um, you can see areas where there's a good entry point and good exit point, right? I guess to answer that question, one of the ways in real estate is again, I keep coming back to the 10-year treasury yield, but oftentimes when you see a 10-year treasury yield invert with the cap rates or the implied cap rates for real estate, um, that can signal one of two things. One is that again, if the 10-year treasury yield is now higher than what the cap rate is, implied cap rate is returning, that can signal you either are about to enter a time when interest rates have to come down. And if that is the case, you did a good job if you entered at that point here, because now that means that the interest rates will bring the treasury yield down, and you now have the ability, you entered early and now your cap rate has to go up. It almost has to, right? And so that's one way. The other aspect, though, is if that doesn't happen, if you look at the market as a whole and, hey, all these different components that Jason was talking about, you know, consumer sentiment, how much are people actually paying down their personal debt, all these different components. If that's not going that well, it could also mean that, hey, that imbalance, that difference between the 10-year treasury and these implied cap rates, it actually means that it's a bad time to go into it further, right? So hopefully that makes sense. It's a lot of different numbers and jargon in there, but that's basically one way to think about it. However, to go back to Jason's point, um, sometimes when you look at real estate as an asset class, if you're very pro, um, maybe it's good to get in if you're looking at it and you're very bullish for the long run, right? Again, going back to what I originally said, sometimes time in the market is better than timing the market. So I'll pause there.
Perfect. Thank you, Brian, for that. And to finish the conversation, Jason, one question in the chat from Eduardo is about what are the most important questions investors or buyers should ask before committing to a real estate deal or sponsor?
So the most important questions to a real estate deal. So if I, as an investor,
Yes.
I would ask,
Yeah.
where's the question in the public chat? I'm trying to find
It's
it
in the
here.
LinkedIn chat. The public chat is is the
Oh,
one we
okay.
have
I
for
was
you
like,
too.
I didn't see
So
what that
it's a
was.
link.
Yeah, I mean, I think that's certainly a very there's a lot of elements to include here because you have to know exactly what this deal might you're talking about, what kind of asset class, or we're talking commercial or residential kind of situation. But I assume that you were going to take this um, as an investor. And I would say that if you don't know that right off the bat when you're going already to that table, you do need to be working with other folks that are familiar with this and how to structure your deal. Um, we there's so many folks that are on this call right now that you should be talking to, right? How to evaluate these deals, how to make sure that you're making this investment because it's not for everybody. I know that there's also a lot of I've always been in the periphery. I've never been an agent. I love supporting small businesses, but I also have seen a lot of the headaches, and so some things I'm not necessarily that interested in personally to get in. I'd rather sometimes maybe invest my money into other things, and so I would say that the caveat is work with a trusted real estate professional. Talk with your accountant. You need to have a nice structure all around you of people that know what they're doing to help coach you on this. So don't go it alone. Is my suggestion to you.
Awesome. Thank you, Jason. And to close, everyone, I want to leave you with key takeaways, three key takeaways. First, real estate is still an important asset class. You know, uh, you could go bullish in it for some years. We'll go into a transition period, but it must be evaluated with more discipline and precision than in the prior market cycles, as Brian was explaining. Second, market opportunities increasingly being shaped by broader forces such as demographic change, as Jason was suggesting, cross-border movement, technology, shifting consumer behavior, ethnicity, all that stuff is playing a lot into this asset class. And third one, a strong real estate strategy is not just about the returns, but also about execution. Going back to Haido, risk management, liquidity, taxes, and long-term portfolio construction. Those are the things that you need to put into consideration when it comes to this asset class. And with that, I want to thank again our speakers, Brian, Jairo, Jason. Thank you for joining me today and for having a great conversation.
Thank you.
Thank you.
Thank
Great
you.
job.
Great job, Joshua, and thank you, Angeles, to the Angeles
Thank you.
family.